Hello, I'm John Bachman. Welcome to Money News on Newsmax TV. We're here in South Florida, where surrogates for Mitt Romney have spread out across the area ahead of the last presidential debate. Today we had a chance to speak to one of those surrogates, Charles Schwab, the famous investor, about what he thinks about the market and what it's going to take to get the economy going. There are conflicting economic indicators out there right now. We've seen housing starts up.
That's looking good.
That's looking good. The stock market is up close to its all-time high of 2008. Right. But also we're seeing some earnings come in from companies, and I know Google today missed its goal and its stock price fell. Do you think that the Dow Jones Industrial Average in the stock markets right now, these gains we've seen as of late, are these real gains, or do you think we're headed for a correction?
Well, I think a great part of the gain comes from the huge easy money system that we have now. We have interest rates that are so low, record low, and that in this relationship to the stock market means the stock market is adjusting to those low rates, and that's a reasonable thing, but it's not a real thing, a long-term thing, I don't think, because you need to have growth expansion of the GDP. We need that desperately. It really hasn't grown whatsoever in the last 3 or 4 years.
Let's talk about quantitative easing. I know the Fed just announced another round of that, and obviously the stock market responded favorably to that announcement. The rates, of course, are going to stay low for several years. Do you think stocks will continue to climb at all if that's going to be the long-term policy of the Fed?
Well, I think as the Fed continues to debase our currency, it will be the only outcome is commodities go up in value, stocks go up in value, and hopefully real estate. I mean, that's sort of what they're trying to jigger here, I think. And I think it's been, in my view, is over manipulation. They haven't let the free market systems for credit really be available. They've manipulated rates all the way through, and I think they've overdone it, in my personal opinion.
So there have to be some sort of correction or some sort of change in direction.
I think something's going to happen. Either inflation's going to go crazy, or rates will go crazy without their being able to control it.
In the banking industry, we just recently saw Citigroup's Vikram Pandit. He released his third quarter earnings, and then suddenly just up and left. And
well, I think he and the board is very disappointed with the outcome. I think it's a time for change at Citicorp. I think it was absolutely the right thing to do, and it's sort of the way I think about what we have in the White House right now. We need to make a change. We tried like crazy the last 4 years. Nothing has happened in terms of a positive economic outcome. Same thing with Citicorp. I think it's a change. I think the board had to make that change.
Do you think these big banks now are in better shape than they were in 2008? There hasn't been any real systemic change in the way they do business. Could we see another crisis like we saw then?
No, I think the banks are in substantially better shape. They've bolstered their capital positions. They've reduced their risk in terms of their trading risk on their balance sheets. They're simply almost over-regulated now. I mean, there's a choke chain on every bank, and you're not going to see any problems with banks right now.
And it was just a leverage issue. You think that's the main issue that's been solved, and that's been... I
have always thought that the key reason for the meltdown of '08 was excess leverage. Some institutions, some banking, investment banking, went up to 30 and 40 times capital. And similarly with Freddie Mac and Fannie Mae, they were up to 40 or more times capital. It was simply over leverage. And that was inspired by government policy, actually, that portion. And now, of course, it's in receivership held by the US government. But I think some of the firms like Bear Stearns and all went to way too high a leverage, and that was really the core problem that we had.
Let's talk about the unemployment rate. It recently fell below 8% for the first time in 43 months, or whatever that number is. I'm not exactly sure. And that a lot of that had to do with the demand for part-time workers. What's your take on these unemployment numbers right now? We saw more people jumping back into the job market today. Do you have faith in these numbers? Are we paying too much attention to these numbers?
Well, I think we're all definitely in favor of more employment, and we would love to see unemployment go down. Nobody loves a high unemployment number. You know, whether or not there was some manipulation at, who knows? I understand that they left out California in the calculations, one of the biggest states and has one of the highest unemployment I think it's over 10%. We in California is where I live, and I think that had a great amount of impact on the favorable change. But we all want it to come down. We want unemployment to come down to 4 or 5% and get back to where we were in normal times.
Let's talk strategy. Since I have Charles Schwab here, I'd like to get you some free investing advice from you. We talked about monetary policy. It's going to stay loose for a long time here, whether we like it or not. The recovery is tepid at best. We don't know what we're going to see. What strategies should investors adopt these days if they want to maximize their investments?
Well, frankly, my recommendation would be stick with very classic, great companies, well-known brand companies that pay a fair dividend, 3–4%. They will have the ability in any kind of environment to adjust to inflation if that comes about and still be able to pay a dividend. You'll have to expect a little bit more volatility. The stock prices will go up and down, but I think you'll have much more protection if inflation comes our way, and it's hard not to see that occurring given the easy money that we've seen in the last 4 years.
How susceptible is the U.S. economy to be falling victim to what we're seeing going on in Europe right now? Spain may be close to requesting another bailout. German policymakers are starting to warm up to the idea of a rescue. Would a Spanish bailout prevent an utter crisis worse than what we've seen in Europe? And would it lower yields in Spanish debt auctions and calm markets across the world?
I think we've already gone through the worst of the European crises. I think they've set up the mechanisms for Spain and other countries to get sort of bailed out. There are provisions, of course, they've got to tighten up their budgets and so forth. But the real issue, the real important thing is get America growing again. We are the largest economy really in the world still, even more. I was just in China, as a matter of fact, and had a first-hand view there. They're a big economy. There are many, many people. There are 4 times more people there than there are here. It's an interesting economy driven by a communist party as such, but there's a lot of entrepreneurs at the lower level. But I think America has to get back to its leadership, not only in economics, but also, I think, in our strength of our military. I think we want that national security. That's really important to me, and I think every American.
Last question for you. The American people say, Charles Schwab, we want you to fix the economy. You have a mandate. What do you do? What are your first 3 steps?
Well, certainly the first thing I would do as a leader, this is what I do, is try to get confidence back. And that would require me making sure I give enough incentives to the people in the country to work hard and get rewarded well. And that doesn't mean, it probably means lower taxes. It probably means all the things that would lead to natural growth that I would encourage. I wouldn't be bashing one sector of the society against another bash. You know, the rich pay 40%, the top 1% pay 40% of all taxes. Yeah, we could jack it up to maybe 45%, I suppose, but what's that going to satisfy? Does that take away incentive? I think it does. You want to make sure you incentivize the people who create jobs. And it happens to be in society, the people who create jobs happen to be certainly the most innovative people, the best leaders, the people who do have capital. Every job created in America requires an investment. And my guess, calculation, is about $100,000 required of investment to create a new job. So you want to make sure people who have money and capital aren't demotivated. They've got to be incentivized. And there are natural ways to do that, and one is taxes.
All right, Charles Schwab, thanks so much for spending some time with us.
Thank you.